Hello everyone, PS from PS Invest Plays here today. Cloud service providers and enablers and social media stocks have been on a tear in 2020, but have seen a downward pressure in 2021. Is this trend going to continue in 2021, or we can expect a higher price movement on the upside in 2021 and beyond? Today, we're going to look at Fastly, a cloud provider enabler, Snapchat, a social media company, where we will understand their business, their financials, review their charts using Elliott wave theory, and see how we can make money. So stick around. I think you'll like what I have in store for you today. Fastly, ticker FSLY. Fastly is an American cloud computing service provider. Its network acts as an edge cloud platform, which is designed to help developers extend their core cloud infrastructure to the edge of the network, which means closer to the users. Fastly continues to stand out above other content delivery network CDN providers such as Akamai and Cloudflare. It builds itself as the platform built for all of your builders. Hence, not only does it provide the infrastructure for edge computing, but it also allows for developer control, giving customers the flexibility to set and configure systems according to their needs. After a strong run up through much of 2020, Fastly stock has experienced a slowdown that began in October and then accelerated downward in February 2021. The stock price is trading effectively where it was a year ago at this time. And just when the stock began to show some solid recovery, a software bug briefly took down roughly 85% of the company's service network. Weirdly, this service interruption should point investors toward an opportunity in Fastly stock and not sell the stock. Revenue, gross profit, EBITDA, net income are extremely good for Fastly. The price to sales or PS ratio had also surpassed 40 early in the year. Today, that sales multiple has fallen to about 18. The stock has become considerably more attractive from a valuation standpoint. This is also indicative in the charts where I see the stock price to almost triple in the next 5 to 6 years. Looking at the chart for Fastly, the bull run that started in 2020 has ended, and also the good news is that the corrective cycle, which was a 76% correction to wave 1 price, is also over. Fastly now seems to be in the third and the most powerful impulse wave, which should take at a minimum the price of the stock to $215, which is a 284% upside in the long term, which is a time horizon of 5 to 6 years. If you like this video, please don't forget to subscribe, hit the like button, and share this video with your friends and family. The second stock that we are going to look today is Snapchat. Ticker SNAP. S-N-A-P. Snap Inc. is an American camera and social media company. The company developed and maintains technological products and services such as Snapchat, Spectacles, and Bitmoji. 2 years ago, Snap appeared destined to watch its business be eroded by the 800-pound gorilla of social media, Facebook, as the growth in its user base stagnated. However, improved monetization, proprietary content, and augmented reality (AR) have changed the game for Snap stock and sent it to record highs. Snap's strategy seemed to work as the company resumed growth in its daily active users (DAU) count and experienced larger revenue increases. As of the end of the first quarter, Snap reported 280 million DAUs, up 22% over the previous 12 months. Unfortunately, this has taken Snap's price to sales ratio to 32. That means that comes in well above the PS ratio of Facebook, which is 10, Twitter 13, and Pinterest 22. Facebook and Twitter also turned a profit in the previous quarter, a fact that may reinforce the investment case for those stocks over Snap. Also, much of the increased DAUs came about due to the pandemic forcing more activity indoors. Even by its own admission, a large portion of its DAUs come from younger users. Unfortunately, this demographic commands low earnings power compared to older peers. Moreover, Snap explicitly stated that user growth could stop if users do not perceive its products as fun, engaging, and useful. The difficulty of defining that concept could deter investors who seek a more solid investment case. Additionally, management mentioned the high bandwidth needs of Snap's products, a limitation that could affect growth outside of the developed world. Although Snap has staged an impressive comeback with its added functionality and move into AR, investors may want to avoid this company for now. This is also indicative in the technical review where I see stock price decline. The bull wave that started in Snap in 2019 seems to be over, and currently Snap seems to be in its corrective phase of wave 2. I see the support for Snap stock to be around $31 and resistance to be around $20 or $21. It is almost halfway done with wave 2, and I see the price to decline by at least 50%, taking the price down to $31 in the short term, the time horizon being 8 to 12 months. Now let's summarize. Fastly, I would recommend buying the dip. Any dip below $50 is a great buy zone. Long term, 5 to 6 years, you can expect a 300% upside potential on the minimum. For Snapchat, my recommendation is to avoid the stock. There is a 50% downside risk in the Snap stock. What do you think of this analysis? Leave a comment and let me know. As always, don't forget to subscribe, hit the like button, and share this video with your friends and family. Until then, bye-bye.